Compounding, the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. A force so powerful that it could turn a few $100s into millions. Imagine monthly contribution of $2,000 returns you $31 million at age 70. So how do we compound to $5 million? Investing into SPY. 20 years outlook. For the past 20 years, SPY total return was around 745% and an average of 11.26% per year. 10 years outlook. For the past 10 years, SPY total return was around 307% and an average of 15.28% per year. 5 years outlook. For the past 5 years, SPY total return was around 85% and an average of 13.18% per year. 1 year outlook. For the past 1 year, SPY return was around 23%. Overall, in the long term, SPY is in the uptrend movement. However, there are two ways of entry, either DCA or entry during pullbacks. Method 1. DCA. So, what is DCA? Dollar cost averaging, DCA, is an investing strategy where you invest the same amount of money at regular intervals, regardless of whether the market is rising or falling. When prices are low, your fixed investment buys more shares, and when prices are high, it buys fewer shares. Over time, this helps reduce the impact of short-term market fluctuations, lowers your average purchase price, and allows consistency and compounding to build long-term wealth. Method 2. Entry during pullbacks. So, when do we entry? In this 1 year outlook, we can see SPY rallied up and then pull back, and then rallied up and pull back. But what if we add some support levels? Here, we can see 5 support levels drawn as we do not know when is the bottom, so we will add them at the support levels instead. For example, looking from today's stock price, we will slowly prepare to accumulate the stock in portion according to the 5 support levels drawn. And looking from the 5th support level upwards, if we had accumulated slowly from there, we would have made some money in June from April. So which is your favorite method? Every ETF has a different focus and expense ratio. The focus tells you what the ETF invests in, such as the S&P 500, technology stocks, dividend stocks, or the broader market. The expense ratio is the annual management fee charged by the fund. Although it's usually small, a lower expense ratio lets you keep more of your returns over time, making it an important factor when choosing an ETF. So, how do we compound our wealth to 5 million or even more? It depends on time horizon and monthly contributions. Let's see some example. For example, monthly contribution of $2,000 per month and compound for 30 years at the average of 11% gives us 5 million in return. For example, monthly contribution of $1,000 per month and compound for 37 years at the average of 11% gives us 5 million in return as well, but with smaller amount and longer time horizon, difference of 7 years. For example, monthly contribution of $3,000 per month and compound for 27 years at the average of 11% gives us 5 million in return as well, but with bigger amount and shorter time horizon, difference of 7 years. One real-life example would be Warren Buffett's, where he compounded his wealth since 11 years old and had a staggering of 100 billion at the age of 90 years old. So we can learn that compounding is one of the best way and eighth wonder of the world. And the best key takeaways is to start early, stay consistent, be patient, and let it compound. And that's how we compound to 5 million or more with this one easy trick. Thank you. Like and subscribe to be first notified for new content. And always remember to compound your wealth.